Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. Markets are repricing fast. The Federal Reserve's policy stance combined with moderating inflation data is triggering a major shift across equities, fixed income, and digital assets. Today, we're breaking down what the latest Core PCE numbers mean for your positioning, why technology stocks just shed over $400 billion in market value, and where the smart money is rotating as rate expectations evolve. Start with the inflation picture. The core personal consumption expenditures price index hit 129.63 in April 2026, up 3.3% year over year, according to the U.S. Bureau of Economic Analysis. That's a tick higher than March's 3.2%. But here's what matters for traders. The trajectory has flattened considerably. Economists expected more persistent upward pressure. That didn't materialize. This moderation is the data point reshaping monetary policy expectations across the board. The Fed held rates at 3.5 to 3.75% at their April 29th meeting. Near unanimous decision, only one dissenting vote calling for a 25 basis point cut. But here's the trade. Futures markets are now aggressively repricing expectations for a Fed pivot. What looked like steady rates through year-end is now shifting toward potential cuts in the back half of 2026. That's a fundamental regime change for asset allocation. Treasury markets caught this shift early. According to analysis from Brennan Wealth Advisors, the 10-year yield climbed approximately 60 basis points, while the 2-year jumped roughly 77 basis points over a concentrated period. That yield curve movement tells you everything about how fixed income traders are interpreting Fed signals versus inflation reality. The belly of the curve, that 5 to 10-year maturity range, is where strategists are focusing attention right now. Bond ladder strategies are back in play as investors position for potential policy flexibility. Equity markets are experiencing violent rotation. Technology megacaps that dominated through the AI rally are getting hammered. Bank of America Private Bank documented that software companies alone lost over $400 billion in market value during early June 2026. That's not a correction, that's a wholesale repricing of growth at any price valuations. When rate expectations shift, high multiple tech gets sold first. We're watching that play out in real time. The money isn't leaving equities entirely, it's rotating. Rate-sensitive sectors are attracting flows. Industrials, consumer staples, sectors that traditionally outperform when monetary policy turns accommodative, these are seeing renewed institutional interest. This represents a fundamental shift in market leadership away from technology dominance toward value-oriented plays that benefit from lower financing costs and improving economic conditions. Here's the macro context traders need. Core PCE at 3.3% year over year is still well above the Fed's 2% target, but the stabilization matters more than the absolute level. Previous tightening measures are showing up in the data. Housing costs, services inflation, the stickier components are cooling. That creates policy optionality for the Federal Reserve. They can maintain their restrictive stance or begin preparing markets for cuts if economic conditions warrant. The critical question for positioning, is this inflation moderation sustainable or a head fake? Data isn't available yet in our research, creating an information gap. Employment trends, supply chain dynamics, global inflation pressures, these variables will determine whether 3.3% represents a ceiling or just a pause before reacceleration. Market participants are betting on the former, but the risks skew both ways. Fixed income investors have specific opportunities here. Intermediate-term maturities are pricing in policy uncertainty. If the Fed does pivot toward cuts, those 5 to 7-year treasuries could rally significantly. But if inflation reignites, you're locked into yields that look inadequate 6 months from now. Duration management is critical in this environment. Brennan Wealth Advisors and other strategists are highlighting bond ladder approaches that provide reinvestment flexibility while capturing current yields. Technology sector technicals are at inflection points. After shedding 400 billion in market cap, software stocks are testing support levels established during previous corrections. Volume patterns suggest capitulation selling in some names, potential bottoming in others. But fundamental questions remain. Were valuations justified by AI growth prospects or inflated by momentum? Rate-sensitive investors are saying inflated. Growth investors are looking for entry points. That debate determines whether this is a buying opportunity or the start of a longer derating process. The rotation into industrials and consumer staples isn't just defensive positioning. These sectors have legitimate operating leverage to improving economic conditions. If the Fed cuts rates while avoiding recession, which is the soft landing scenario markets are pricing, these companies see margin expansion from lower input costs and stronger consumer demand. That's the bull case driving current flows. Cryptocurrency markets are playing a unique role in this environment. According to research on alternative assets, some investors are viewing digital assets as portfolio diversification during monetary policy transitions. Crypto's correlation with traditional risk assets has fluctuated, creating potential hedging opportunities. Technical analysts are watching 50 to 60% retracement levels from previous highs as key support zones. Whether Bitcoin and Ethereum can hold those levels during equity volatility will determine if crypto serves as safe haven or risk-off casualty. Here's what's missing from the current picture. We don't have May PCE data yet. We don't have recent Fed communications beyond the April 29th meeting. We don't have current Treasury yield levels reflecting the most recent repricing. In fast-moving markets, that 6-week information lag matters. The landscape could have shifted materially. Traders operating in real time need to monitor incoming data releases closely. International factors aren't captured in this domestic-focused analysis either. Global central bank policies, geopolitical developments, international inflation trends, these variables influence U.S. monetary policy and market conditions. The Fed doesn't operate in isolation. If European Central Bank or Bank of Japan policies diverge significantly, that creates currency and capital flow dynamics that impact U.S. asset prices. Practical positioning considerations for this environment. In equities, balanced exposure between growth and value makes sense given uncertainty around Fed timing. Overweight technology worked brilliantly through the AI rally, but that trade is facing headwinds now. Rate-sensitive sectors offer catch-up potential if policy moderates. In fixed income, intermediate maturities provide the best risk-reward given yield curve positioning. In crypto, technical support levels and momentum indicators determine whether current prices represent value or further downside risk. Risk factors that could derail the current narrative. Renewed inflation pressures would force the Fed to maintain restrictive policy longer than markets expect. That would trigger further multiple compression in equities and losses in fixed income. Unexpected economic weakness could push the Fed toward aggressive cuts, but in a recessionary context that wouldn't support risk assets. Geopolitical shocks could override domestic monetary policy considerations entirely. The technology sector washout deserves specific attention. 400 billion in market value doesn't evaporate without reason. Profit-taking after substantial gains, valuation concerns, and shifting investor preferences all contributed. But the speed and magnitude suggest forced selling, possibly from leveraged positions or momentum strategies unwinding. That creates volatility and potential opportunity depending on individual stock fundamentals and time horizon. Charles Schwab and other major institutions are publishing mid-year outlooks emphasizing this transition period. The consistent theme, markets are moving from Fed tightening regime to policy flexibility regime. That transition creates volatility as different asset classes and sectors reprice at different speeds. The investors who navigate this successfully will be those who remain flexible and data-dependent rather than anchored to previous winners. Bottom line for traders, Core PCE at 3.3% with Fed funds at 3.5 to 3.75% creates a narrowing gap that supports dovish policy expectations. Technology stocks are experiencing violent rotation after massive outperformance. Rate-sensitive sectors and intermediate-term fixed income are attracting flows. Cryptocurrency markets are being tested as potential diversifiers. The sustainability of these moves depends on incoming inflation data, Fed communications, and economic fundamentals that aren't fully visible yet. Critical levels to watch. Treasury yields across the curve, especially that 5 to 10-year belly. Technology sector support zones established during previous corrections. Industrial and consumer staples, momentum indicators. Crypto technical support at 50 to 60% retracement levels. These price points will signal whether current trends extend or reverse. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.